very best businesses are the ones that earn a high rate of return on tangible assets and grow. But even ones that don't grow, if they earn a high return on tangible assets, and then of course if you don't pay too much, they can be a good investment. They're a good business to start with by the high returns. If you pay too much for them, you can turn a good business into a bad investment. But if you pay an appropriate price, you can do all right. Now the big mistake which we made in the early years was to try and buy a bad business at a really cheap price, and it took me about 20 or 30 years to figure out that wasn't a good idea. But this is the car business, the car dealership business, if run well, can be a very good business. You have no receivables to speak of. You floor plan your inventory. You can lease your real estate. We don't do that. We'll own 95% of our real estate. So you can have very little capital actually invested in the business. And you do a large volume. Van Tile, which we bought, has 78 dealerships. They'll average over $100 million a dealership. So you can work on fairly narrow margins and still earn a high return on capital if you don't tie up much capital into $100 million of business.
And how many car dealerships are there in total in the United States?
Well, there are over 17,000 car dealerships in the United States. And the interesting thing is if you go back 40 or 50 years, there were in the 30,000. So while the country has grown dramatically, and actually the number of nameplates in the car business have grown, you've cut the dealerships almost in half. So the average dealer now does far greater volume than when I was growing up. The banks earn on assets. They don't earn on net worth. You calculate it eventually as to what they earn on equity or net worth. But assets are the earning factors, and they've changed the rules so that you have to have more net worth per dollar of assets. And obviously, if you have more net worth per dollar of assets and you're earning a constant amount on assets, your earnings on net worth go down. Now, they were ungodly profitable. The better ones were back 15 years ago, or 10 years ago even, when they had high ratios of assets to net worth. And some of them even cheated in terms of having even more assets than the regulators would have allowed. And you had these sieves, as they were called. Citigroup had a whole bunch of them. So they were off balance sheet ways of even controlling more assets. But all of that sort of thing has been terminated, and now they've got much lower limits as to the assets to net worth ratios. And the bigger the bank, to some extent, the bigger the bank, the lower that ratio can be. So what was a very profitable business has been turned into a good business if executed well. It's a pretty simple business. I mean, you get your money cheap, very cheap. Wells Fargo will have $1 trillion roughly, or close to that, of depositors' money, and it's probably costing around 10 basis points. Now, most people think you get $1 trillion of money and pay 1/10 of 1% for it, would find some way to do something profitable. But the banks have always gotten in trouble on the asset side. They've never gotten in trouble on the liability side, basically. But they really haven't gotten in trouble too much on the expense side. But they go crazy occasionally on the asset side, and what they do is they start copying what their dumb competitors are doing. That happens in every business, but it's particularly virulent in the banking business. John Stumpf once said, he said, "I don't know why we keep looking for new ways to lose money when the old ones were working so well." But they do, and they copycat. That's a great danger in any business. I warn our managers against it all the time. If anybody comes to me and says, "We want to do this because the other guy is doing it," I say, go back to square one and come up with a better reason. But human nature is such that you do want to do what others are doing. I one time was at a directors meeting where a leading property casualty insurance manager, a very well-known guy, was making a presentation to buy a life insurance company. And he was going through all these kind of silly reasons why they should do it. And he realized that the crowd was kind of catching on to the fact these reasons weren't too good. So finally, he just threw up his hands and said, "Oh, all the other kids have one." And basically, there's a lot of business decisions made because all the other kids have one. Well, I did use in a talk I gave 15 years ago at Sun Valley and got reprinted in Fortune, a standard of total market capitalization to GDP, and that I used that because it showed at that time how extreme things had gotten. I think they'd gone from
Extremely high.
Yeah, they'd gotten from 40% of GDP, which had been kind of standard over the years, they'd gotten up to like 170% or something. So it wasn't designed to be a fine-tuning type of valuation, but it showed things that really changed in a big way. A very high percentage of the time, stocks are in what I call a zone of reasonableness. This is not something, we all know that pi is 3.14159, and little kids can sometimes give it out to hundreds of decimal places. But the stock market's not like that. There's a range of reasonableness, and most of the time throughout my lifetime, it's sold in the range of reasonableness. That range changes over time as earnings accumulate and interest rates change and all that sort of thing. There's only been about 5 times in my life, I think, that I've actually spoken out publicly to say it was outside the range in one direction or another. The most recent one being in October. I was early in October of 2008, and I said stocks were cheap, and I wrote an op-ed in the New York Times. But I'll probably have some chance, once every 5 or 10 years to make a definitive statement. There is a big zone of reasonableness. Anybody thinks they can pinpoint it is crazy. It's not that precise. And fortunately, you don't need to. If you buy good businesses at reasonable prices and hold them, you're going to make a lot of money. And that's true of stocks as a group. It's true of individual companies. And let me point out one other thing. We talk about 2% a year gains now, and everybody says that's terrible, and it's not our potential and everything. The population is probably going to grow at a little less than 1% a year. So if you have 2% real gains, that means in a generation, in 20 years, you will have greater than a 20% per capita gain in real GDP. Now, real GDP is about $54,000 per person in the United States. If you get a 20% real gain per capita, that's $10,000 per person more per capita income in the United States in one generation. That's fantastic. I mean, it may not be as good as we did in some of the decades after World War II, but if you go back in history, centuries went by without getting anything like that. And 20% gain, how would you like to have that distributed somehow evenly across the population? You'd be rid of all poverty and everything else. So even at our present rates of gain, this country is turning out more and more stuff per capita year by year, and it will continue to do so. We have a marvelous machine, and it has worked extraordinarily since 1776. In my lifetime, I was born in 1930. In my lifetime, the real GDP per capita in the United States has increased 6 for 1 person's lifetime.
Amazing.
I mean, nothing like it's ever happened. And it isn't because we're smarter, and it isn't because we work harder. It's because we have a system that unleashes human potential. And just look at the people in this room. I mean, you have more potential than you thought you had 10 years ago or 20 years ago. You certainly have more potential than your parents thought you had.